I've been asked to talk this morning about yesterday's presentation by Sarah Hunter, who is the Assistant Governor of the RBA, also the Chief Economist for the RBA. Being Assistant Governor is vastly more important than being Chief Economist. And Sarah gave a very detailed and competent discussion of what is the conventional view of the impact of tariffs on the international economy. That is to say that they push up inflation and reduce output. And you'll see a similar kind of presentation done overnight by the OECD, saying pretty much the same kind of thing. And in particular, what Sarah examined was the shock of those things happening and what that might do potentially to GDP and what it might potentially do to inflation. In talking to myself, I found it was one of the very few times in which I've had the advantage of calling upon my background back in the day on being an Australian Trade Commissioner and serving in Australian embassies and having written documents for international briefing for Australian ministers in international trade. So therefore, I had a little bit of specialist knowledge, which allowed me to get away with particular things, I think, in conversation. And I was really interested to find that they really don't have people in the RBA who are following individual policymakers in the Trump administration the way I've been talking about them in recent months. So they don't have anybody, or don't appear to have anybody talking about what Scott Bessent has said about the kind of tariffs or the kind of competition they're involved in. And so what they're doing is they're taking the same generalist view that the OECD is taking. The problem with the generalist view is it starts from the position that you've got a whole lot of countries in the world which are perfectly competitive on international trade and playing by the rules of international trade. And countries that are unlikely to be at war with each other, okay? That's not exactly the situation that we find ourselves in right now in international trade, particularly in the situation between China and the United States. What we're seeing with China is that China is, of course, a Marxist-Leninist economy. And in a Marxist-Leninist economy, the theory is of Marxism-Leninism is to build up international monopolies in things like processing rare earths, for example, or other materials, trying to build up a monopoly in the processing of nickel, for example, or copper, for example, or a number of the other base metals in which China is now the overwhelming refiner in the world, and other parts of manufacturing. And it doesn't envisage a world in which the largest manufacturer in the world is artificially depressing its exchange rate, even though it's promised the International Monetary Fund to have a freely floating exchange rate. The largest exporter in the world still has a managed exchange rate as if it is a developing economy. Because if they had a floating exchange rate, as they promised to do when they joined the International Monetary Fund, what you would see is that the RMB would be floating at a much higher level than it's currently priced in its controlled market. And therefore, it would be importing more international goods. And therefore, its surplus in the international markets would be much, much less. And the demand for goods, international goods and services, which could be sold to China, would be much greater. And so the international environment would be in balance. And you wouldn't have the situation where other countries therefore need trading with China need to impose tariffs. You wouldn't be living in that world that the OECD and general economic theory currently believes we are in. And so what you've got is really a very uninformed major institutions responding to an international trade shock, which is entirely different in character than it actually is. And you also have an international community that don't follow what Peter Navarro might have said about when he was last year about the negotiations, and don't follow what Scott Bessent is saying when Scott Bessent says that the US only wants to generate competition, only wants to rebuild its markets through tariffs in very specific areas, such as drugs, such as precision manufacturing, and in motor vehicles. So if you're starting from that position, you're going to have a lot of misunderstanding in public institutions, and that's exactly where we've got. But as a result of that, what public institutions believe, there is a great deal of unspecifiable risk. And what you saw with the presentation yesterday is there was a very able presentation by Sarah of those areas of unspecifiable risk. But because the RBA thinks that we're in this world of unspecifiable risk, and other institutions think the same thing, they're not going to die wondering whether they cut rates slow enough. So they're not responding to an equilibrium situation, the sort of thing that I'm describing with my model. They're describing to a situation of risk that they can't actually specify. And in that circumstance, the major potential risk is potential slowdown and higher prices. Now, it's really interesting then for me to look at what's actually happening in the data, particularly in the US economy. I've talked about the best indicator of growth, and that is, and the most reliable indicator of growth of the US economy, which is the Chicago Fed National Activity Indicator. And I was talking about that, I've spoken about that because in the great financial crisis that we had in 2008, it was overwhelmingly the most reliable indicator that we had. Now, what's happening there now, in spite of these supposed negative shocks to the US economy from tariffs, what we have so far is that for the first 4 months of the year, the Chicago Fed National Activity Indicator is showing growth in the US economy above long-term trend. That is to say, in December, it was 0.16 of a standard error higher than long-term trend, and in the US, it's 0.5. It's just teetering above a long-term trend. Now, what we actually hope is that it falls below long-term trend later in the year, and that encourages the Fed cut rates, and that will give us our soft landing, and that will give us the fall in the US dollar that we need to restart international commodity prices. That's what we hope is happening. But that's really not part of the emerging understanding that we saw yesterday. So the other thing that's happened is, so one of the things that's supposed to happen with the US is the output is supposed to fall. Well, the data shows that that's not happening. The other thing we can look at is, and you can see that in our model of the US economy based on the Chicago Fed National Activity Indicator, which is shown on the screen. The other interesting particular number is that what's supposed to be happening at the moment is because of tariffs, you're supposed to have higher inflation in the US. And Scott Bessent was really interesting a couple of days ago in pointing out that the CPI inflation that we've got is coming in, as far as the US CPI, below where people expected it to be. The headline CPI is currently coming in at 2.3%. Remember, that's pretty much their target, pretty similar to ours. Now, headline isn't as low as that, but it has been falling. So in February, core inflation, sorry, the 16% trimmed mean of inflation was 3.1%, but for the last 2 months, it's 3% and 3% again. CPI less food and energy is 2.8%, which obviously shows that if there's supposed to be a core inflation effect on the US economy. It's not happening. What is happening, however, and the reason that Scott Bessent said that's not happening is because Chinese suppliers to the United States are taking the hit themselves in order to continue to have market share. Now, where we can see that, though, the effect of that, we can see the beginning of some effect of that in the Chinese data, because in the last couple of days, we've had data released by the Chinese Bureau of Statistics. And what's that shown is that their manufacturing CPI, their manufacturing confidence indicator has fallen slightly. And also that their consumption of coal has fallen slightly. And that means that manufacturing is slowing down because only some of their manufacturers are capable of supplying in this current situation to the US. And also there's been a decline, very interestingly, in coal consumption, which means electricity use has declined. And electricity use in the Chinese economy is usually associated with factory output. So it's definitely the case that the Chinese economy is taking a hit in terms of factory output. And it's definitely a case they're struggling, but they are supplying this market. But right now, the effect, the negative effect that's supposed to happen in theory to the US economy just isn't happening. It isn't happening in prices. It isn't happening in output. Now, it may happen later in the year. We actually hope it does. But right now, the fears that are being displayed by the OECD and others really are not justified in terms of the effect of this administration's trade policy upon the US economy.